Hey, it's Matty, your mortgage Phil Jackson. Rates are always top of mind when it comes to housing, and refinancing is just one of many ways to get a better deal on your mortgage. Timing's everything, but sometimes you just need to work with what you got. So let's run the triangle offense with 9 plays to get you a better deal out of your next mortgage, or better yet, the one you got right now. Ready? Let's post up. First, if your lender is also your servicer, call and ask if they offer a rate modification. A rate modification works kind of like a refinance, but it limits the fees and time it takes to process. The modification rate may not be equal to market rate of a refinance, but it could be a cleaner and quicker process. It could work like this. Say you bought your house a year ago and market rates are down a full 1%. To get the 1% lower, you'd have to requalify and redocument your file with a traditional refinance. But if you leverage the modification, your lender may not offer the full point, but let's say half a point for limited costs and requirements. Usually it'll take the lender a year or two to assess the servicing portfolio, so it's not instantaneous that your loan will become eligible. But your lender may figure if they don't offer you anything, you might pick up the phone and score a traditional refinance somewhere else. Not all lenders offer these, which is why you need to ask the right people. It's only available from the originating lender that sold you the loan and still has the servicing. So ask about the fees. They could range from a few $100s to maybe $1,500. Let's say you have a massive liquidity sitting on the sideline and you're a little apprehensive on where you can earn the best return. If nowhere to invest, you could reduce your mortgage cost by applying those funds to the balance and recasting the payment. But before you do anything, you need to call your lender and ask if they offer recasting. Lenders are not going to recast a loan for $500 of principal payment, but they could require as much as $10,000 or 10% of the balance. With a large enough principal paydown, this will reduce your monthly payment and interest expense versus the current amortization. Important, this doesn't reduce your rate. You keep the existing rate and the term, but the payment improves based on the reduced balance. These requests work great if you sold your old home before you bought the new one and you want to displace that equity. There are some prerequisites on how early you can request one of these, and the fees are usually only a few $100s. Like rate modification, not all lenders offer these. Increasing any down payment on a mortgage reduces risk and potentially your interest rate. Inversely, if you refinance for cash out purposes, that reduces your equity and potentially increases your interest rate. Many real estate investors routinely take cash out from their homes because they can use the cashback proceeds like tax-free income. If you earn $100,000, you'll have to pay tax on that money as earned income. But if you withdraw $100,000 of equity from cash out refinance, it's like getting $100,000 in income but not having to pay any tax. Understand that rule doesn't apply in all states, in particular New York. New York's infamous for its mortgage tax, which could be as high as $7 for every $1,000 you take over the loan balance as cash back. New York closing costs are one of the highest in the states without mortgage tax. We all know there's no free lunch. In lending, they call that per diem, which means the daily interest expense on your loan until it's paid in full. Remember, after you close, there's that so-called grace period when you don't have a mortgage payment for a month. The bank isn't letting you write for free. They're just billing you that interest expense the following month. Now, when you refinance, you're going to have an interest expense on the old loan until the new loan kicks in on the funding date. But here's a simple hack you can leverage so the old lender isn't sticking you with some unnecessary per diems. Just don't close on a Friday or a holiday for that matter. As your new lender pays off the old, there'll be some padded interest in the payoff while those funds are in transit. Routinely, your lender will add these because the funds aren't guaranteed. You can reduce all the extra padded interest charges by not closing on a Friday before a long weekend or a holiday when peeps start to hit the highways early. We could be talking about a breakfast expense or a steak dinner, depending on your per diem expense. When you refinance in the traditional fashion, you're likely going to pay costs of the lender, title company, appraiser, and some third-party fees. If you can make up the hard fees in less than 18 months or less, it's usually a pretty good deal. But remember the rules on deductibility based on the loan amount and any points for the rate you receive. Lender fees, appraisal, title work are never deductible. Points paid on the original mortgage can be deducted in full when you purchase the home. But when you go to refinance, any points you pay need to be amortized over the loan. Think of it as a prorated expense. If you refinance the refinance, it's possible to deduct the unused balance of the first refinance points when you do the follow-up refinance. Remember, since the Tax Cut and Jobs Act, the loan limit for full interest deductibility is $750,000 for married couples. More than 80% of all borrowers take out fixed-rate mortgages. Yes, adjustable rate mortgages appear complicated beasts, but you need to understand the main benefit is that they usually offer lower interest rates. Lower rates means less of an interest expense and more of the principal, and yes, you are taking on more risk, and what happens after the fixed period of the ARM is up and you're exposed to the market. Inflation's gone through the roof in the past few years, and so have rates, and with the inverted yield curve, it's hard to find a strong ARM rate relative to their fixed rate counterparts. But inflation cuts both ways, so if rates increase during your adjustment period, it's likely your home value and your salary are higher too. The other side of the coin is that there's a huge risk premium to lock up that money for 15 or 30 years. The average life of a mortgage is only 5 years, and how much extra is that quarter or half a point going to cost you over the next 60 months? Are you going to be in that home for 30 years? Unlikely. Are you going to keep that loan for 30 years? History has shown very unlikely. So unless you're certain on three things, rates are going up indefinitely, you're going to keep that home to term and that loan to term, it's worth considering. Here's a rare gem. Some investment firms also offer mortgages, and some even offer you a mortgage for 100% financing of the sales price, provided that you offer up other collateral, mostly securities in your brokerage account, to protect the lender against default. This could make sense if you have strong income but limited liquidity. If you have to sell assets to make the home purchase work, it could create a taxable event of your investments and leave you with a huge tax bill for moving your money. Now, there are some costs of doing business. The investment company could require a hefty relationship, as much as half the mortgage as collateral. It's a big ask, but it's also a solution. In the long term, your investments could lose value and then be subject to a margin call, requiring you to sell or add in additional capital. Then you have to consider the borrowing cost in combination versus the traditional method. When purchasing, you can always consider making more down payment. People like round numbers, so they usually budget their down payment at 20% so they can avoid good old mortgage insurance. But if you got extra funds, ask your lender about how more money down will impact your rate choices. Lenders will price loans according to risk, and when you make more down payment, it lowers the risk and thus lowers the potential interest rate. It may not be a huge improvement, but could be an eighth or a quarter, or less of a fee or a credit for the interest rate chosen. Just like ARM comparisons, lenders usually won't show you the benefit unless you ask, so it's always important to inquire. If none of the above are an option for you, hang on. The best kept secret to saving money on your mortgage is to pay extra principal. Don't feel that you're locked into your mortgage because rates have gone higher. Make the existing loan work for you. If your lender doesn't offer recast or the rate mod, no worries. Just double up on the payment once per year. That 13th payment in a 12 calendar month year will take a 30-year note, depending on the interest rate, down 4 to 6 years. Some prefer the biweekly payment strategy as it stays in line with your paycheck, making it easier to budget. Your biweekly payments add up to 26 payments or 13 monthly in the calendar year. The longer you're into the amortization of the existing loan, the less you're going to pay on the interest expense. So if you're 15 years into your 30-year note, it may not make sense to even refinance into another 15-year because you're winding back the clock on the amortization. Interest rates can be superficial, so a refinance for a lower rate is not always your best move. When you pay more of the principal, you pay off the loan faster, effectively borrowing at a reduced rate than the one you have currently. So there you have it. 9 ways to save. Choose one. I'm Maddie. That's it. That's all. We'll see you next time.